What do you think about gas prices?
Too expensive.
For the past few years, we've been hearing about inflation constantly. Prices for everything from groceries to rent have been on the rise, leaving many people feeling the pinch on their wallets. But now, there are signs that inflation may finally be coming to a stop. Economist, inflation is essentially an increase in prices over time. It can be caused by a variety of factors, including rising costs of production, an increase in demand for goods and services, and even government policies. Narrator, over the past few years, we've seen a number of factors contributing to rising inflation. The COVID-19 pandemic has caused disruptions in supply chains, leading to higher costs for businesses. This, in turn, has been passed on to consumers in the form of higher prices. Economist, in addition to supply chain issues, we've also seen an increase in demand for certain goods and services. For example, the demand for home-delivered groceries has skyrocketed during the pandemic, leading to higher prices for these items. Narrator, but now, there are signs that inflation may be slowing down. One factor contributing to this is the recent dip in oil prices. Lower oil prices typically lead to lower costs for businesses, which can then be passed on to consumers in the form of lower prices. Economist, another factor to consider is the overall state of the economy. When the economy is struggling, we tend to see lower levels of inflation. With many businesses still struggling to recover from the impacts of the pandemic, it's possible that we may see a slowing of inflation in the near future. Narrator, but it's important to note that inflation is a complex issue, and it can be influenced by a wide range of factors. While it may be slowing down now, it's always possible that we could see an uptick in the future. Economist, it's also worth noting that the Federal Reserve has a target inflation rate of around 2%. This means that they aim to keep inflation at a steady, moderate level. If we see inflation rising above this level, the Fed may take steps to try to bring it back down. Narrator, so, is inflation finally coming to a stop? It's hard to say for certain. While there are signs that it may be slowing down, it's always possible that we could see an uptick in the future. The best we can do is keep an eye on economic indicators and stay informed about how inflation may be impacting our finances. Inflation is a natural occurrence in any economy, but when it gets out of control, it can have serious consequences for both individuals and businesses. High levels of inflation can lead to rising prices, economic instability, and a decrease in the value of money. So what can we do to slow down inflation? One of the most effective ways to slow down inflation is through the use of monetary policy. Central banks, such as the Federal Reserve in the United States, have the ability to control the supply of money in the economy. By increasing or decreasing the supply of money, central banks can influence the demand for goods and services, which in turn can affect prices. For example, if the central bank increases the supply of money, there may be more demand for goods and services, which could lead to higher prices. On the other hand, if the central bank decreases the supply of money, there may be less demand for goods and services, which could lead to lower prices. Another way to slow down inflation is through the use of fiscal policy. This involves the government using its budget to influence economic activity. For example, the government could increase taxes or reduce spending in order to slow down inflation. This can be effective in reducing demand for goods and services, which can help to lower prices. In addition to monetary and fiscal policy, there are other ways to slow down inflation. One way is through the use of price controls. This involves the government setting limits on the price of certain goods and services. While price controls can be effective in reducing prices in the short term, they can also lead to shortages and other unintended consequences in the long run. Another way to slow down inflation is through the use of productivity gains. When businesses become more efficient, they can produce more goods and services at a lower cost, which can help to reduce prices. This can be achieved through the use of technology, training and education, and other forms of investment. Finally, it is important for individuals and businesses to be aware of the causes of inflation and to take steps to protect themselves from its negative effects. This can include investing in assets that are less prone to inflation, such as real estate or stocks, and being mindful of spending habits. By taking these steps, we can help to slow down inflation and maintain a stable and healthy economy. Inflation is a concept that many people have heard of, but may not fully understand. Essentially, inflation is the rate at which the general price level of goods and services is rising, and subsequently, purchasing power is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. But why is inflation needed at all? To answer this question, we need to first understand the role of money in an economy. Money serves as a medium of exchange, a unit of account, and a store of value. In order for an economy to function efficiently, there needs to be a stable value for money so that people can make informed decisions about how to allocate their resources. If the value of money remains stable, people can plan for the future and make long-term investments with confidence. However, if the value of money is constantly fluctuating, it becomes difficult for individuals and businesses to make financial decisions. This can lead to economic instability, and even recession. So, why can't we just keep the value of money stable and avoid inflation altogether? The answer is that a certain level of inflation is actually necessary for an economy to grow. When the value of money remains stable, it can lead to deflation, or a decrease in the general price level. This may sound like a good thing at first, as it means that goods and services are becoming cheaper. However, deflation can actually have negative consequences for an economy. For one, deflation can lead to a decrease in spending and investment. If people expect prices to continue falling, they may delay making purchases in the hopes of getting a better deal in the future. This can lead to a decrease in demand for goods and services, which can in turn lead to a decrease in production and employment. Furthermore, deflation can lead to a decrease in the value of debt. If the general price level is falling, the value of money is increasing. This means that debts that were taken out when the price level was higher are now worth more in real terms. This can create a burden for borrowers and lead to defaults on loans. Inflation, on the other hand, can help stimulate spending and investment. If people expect prices to continue rising, they may be more inclined to make purchases sooner rather than later. This can lead to an increase in demand for goods and services, which can in turn lead to an increase in production and employment. Additionally, inflation can help reduce the burden of debt. As the general price level rises, the value of money decreases. This means that debts that were taken out when the price level was lower are now worth less in real terms. This can provide relief for borrowers and help prevent defaults on loans. In conclusion, inflation is needed in an economy in order to avoid deflation and the negative consequences that come with it. A stable, moderate level of inflation can help stimulate spending and investment, and reduce the burden of debt. It is important for central banks to carefully monitor and manage the rate of inflation in order to maintain a healthy and growing economy.